So this normally I talk a lot more about the cash flow side of real estate. So today in this webinar, I want to talk a little bit more about the accounting side of it. Okay, so it's pretty much how you go about finding not the cash flow only, but also looking into the income statement and the profit and loss and the balance sheet as well. Okay, so it's mainly to talk about the terminology because this is something that normally in my classes we don't talk so much about it, but I think it is helpful if we as surveyors we also understand what they are and how we can use them to value. Mainly, we use them to value not projects, not real estate, but we use them to value, for example, companies. Okay, so as we are surveyors, there are some RSS guidelines in what we need to know in terms of accounting concepts, in terms of what is the profit and loss, what is a cash flow, and the balance sheet. Okay, so this is normally we need to do this for level one. Okay, and then for the sessions, normally we need to define what the business activities are, accounting principles, like all these are terminologies that we use in accounting. Okay, but mainly in terms of accounting, we need to focus on these main types here. I'm not gonna expand here because my computer is having some problems, but it's mainly like the balance sheet. Okay, so these are the assets and liability and the equity side and the P&L, which is the profit and loss, and the cash flow. One thing that we need to understand the difference between the cash flow that we use to do, for example, valuations and the cash flow from an accounting perspective is that when we do the valuations for properties, we normally use what we call the direct cash flow, i.e., that it is top down. So we start with the revenue, so the rent, and then you're gonna have the operating expenses. Then you're gonna have the capital expenditures and so on, and that becomes your cash flow. Whereas when we look here from an accounting perspective, normally tends to be an indirect cash flow. So this is one thing that we also need to understand from an accounting perspective. Okay. And then there's also this idea of management accounts as well and company accounts. Normally, the management accounts will tend to look more into the profitability of the business, where the cash that is being generated. Where company accounts, the one that you need to central regulators, sometimes some expenses can be deducted from your revenue, sometimes they can't. So this tends to be the main difference, like how things are allocated, because sometimes you're interested in the VAT that your company pays, but it's sometimes this VAT can be, for example, apportioned, and it can also be very much it will change a little bit how the numbers will pan out. Okay, and then if you are doing your APC for the IRCS, it's very basic level that we ask. Normally, it's more to do with level one, so we don't tend to ask them very much, but it's helpful to know. And also, from a modeling perspective, right? Normally, I like to talk about modeling. So, normally, what we do is that we tend to look at reconciling all the three statements. So, the cash flow statement, the income statement, and the balance sheet as well. So, these three statements need to be somehow linked. Okay. And this is one thing that normally takes a lot of time to to do, and sometimes they don't reconcile, so we need to be aware of those. Okay, so when we look at the accounting side, let me just, for some reason my computer is we look at the what are the business activities and investing activities as well. So this is very important because the operating activities is the things that will come as part of your revenue, whereas your investing activities will come from what is like more your capital that you are investing, and they have tax implications as well, and also in terms of revenue. And in real estate, especially if you're looking to what we call REITs, the real estate investment trusts, because the REITs are what we call tax transparent, that they don't pay corporation tax at the company level, but they pay only taxes at the shareholders level. So then sometimes what may be seen as an operating expenditure, or an investment expenditure, can be somehow booked in different ways, and they has as they has like not so much tax implications in return in regarding to the REITs. Okay, so operating activities in real estate will be pretty much the rental side, whereas the investment activities will be pretty much the development side, or the refurbishment, or buying land, buying a building. These are investing activities. So in my case, my simple case here is if you have, for example, a pizzeria, then buying the flour, selling the flour is your operating expenditures. Whereas if you're buying the oven to prepare the pizza, it might be seen as an investment. So in property, it's also one thing that is very complicated, because sometimes we will say, okay, what is the redoing your floor, for example, like replacing the kitchen or replacing all the toilets. Is it seen as an operating expenditure, or is seen as an investment expenditure? And this will have the implications from a cash flow perspective, as well from an accounting perspective, and also from the profitability of the company as well. Because if you're seeing, for example, that you're going to say, okay, my refurbishment is part of my operating expenditures, then it means that your profitability will be lower than if you say, for example, okay, this is an investment capital, so it's not going to go through the balance sheet. It's not going to go through the income statement, but it goes directly to the balance sheet. So that's the nuance in recognizing what kind of business activity it is. So if it's operating, it will go into your income statement. If it's not operating, if it's an investment, then it goes to your balance sheet. Okay. So these are the things. And then if it's operating, it will have an effect on your profitability. But if it's investment, it won't pass by your income statement, but it will pass by your assets. So if you are increasing if you're buying, for example, land, then this will have an impact on your assets. If you're paying debt, for example, then it will have an impact on your liabilities, and so on and so forth. Okay, so I hope that's helpful for you to know. Then we have also, as I mentioned, the debt side. It's not operating, it's more of financing activities. So these are things that we need to know as well when we're thinking about accounting, is where the money is coming from. Because if you're thinking about just, for example, in property, if you're gonna buy, for example, 100% with your own cash, then that means that everything is going to be related to your balance sheet, and then this is there is no, like, for example, implication. For example, if you have debt, because debt, your interest and the loans that you can borrow, they will have an impact on your income statement, because you can book, for example, interest as part of your as your deductible expenses. Okay, so it becomes a little bit technical and a lot of jargons there, but it's just to know that you're gonna have operating activities, investment activities, and financing activities. Okay. And these are important for your cash flow analysis because your cash flow, you need to find out what is coming from your operating side, what is coming from investment side, and how you're financing your operating and your investments. Okay. If it is through equity or if it is through debt. Okay. Accounting concepts, we need just for information, is because we need to understand what are the different standards for accounting. So the UK, you can say that we are operating on the IFRS, then you have the US GAAP, and then you have different standards. So that again, because all those standards, they will tell you what is the what you can actually put as in terms of expenses. It's very structured. Like what can you put as expenses? What can you put as revenue? And one thing that is very different from an accounting perspective and from when I do my valuations from a DCF, from a discounted cash flow perspective, is this idea of accruals, because the cash can be in my bank account, but I cannot recognize this yet as a revenue, if I have received it. So we need to be a bit aware of this idea of accrual. So this accruals is as well like something that will make the difference. If it wasn't the accruals, then all the cash flow and the income statement would have been the same. Because if you receive, for example, today 100, and it is for example, for the consultancy service that you do over 10 months, then you can say, okay, I received 100 today, then it means that my revenue is 100. But that's not the case with accounting, because if you're going to deliver the service over a longer period of time, so for example, over 10 months, as it is your case, then it means that you can recognize this revenue, your profit can increase only by 10 if once you start delivering those services. Okay, so that's very basic concepts here that we need to understand before we dive into the actual financial modeling of the accounts. The accounting elements as well. So we need to know like what the assets, liabilities, equity, income, expenses are. So this is mainly like the terminology. Asset is what you own. So if, for example, it's a property company, then the assets will be the buildings, the liabilities will be the loans, the mortgages, and then the equity will be either the profit that is retained, or it might be the own equity that was put in there. Okay. And then income, expenses, again, this is the part generating from your operating activities. Okay. Another thing we need to be aware of is in terms of the balance sheet, we have what we call current assets and non-current assets. The current assets tend to be more the part of up until 1 year. So if you have, for example, a cash balance there that you can use for straight away, then it's going to be the current assets. And then non-current assets is, for example, your things that can be longer term. For example, it can be a car, or it can be something more that it's not, or your computers, for example, that might have a longer period to use. And then property, normally property comes as property and equipment, plant and equipment. And then you also have this idea of investment property, because investment property is if, for example, a company is investing property. So a developer, for example, British Land, Derwent, and so on, there is not the property, plant, and equipment is more like investment property. And then they have different treatments as well from an accounting perspective in terms of what can be, again, what we can be depreciated or not. Okay, so these are concepts that we need to be aware of. Um, so for us in real estate, PP and investment properties tends to be where we normally focus when we are doing kind of like when you're doing, for example, reporting for funds, for example, we tend to be looking here at this investment property. So if you're a valuer doing valuation for reporting purposes for funds, for example, it's normally being looked at investment property. So it's the fair value recognitions, and then you need to be aware of disclosures for valuation. So this is pretty much like the bureaucracy, I would say, of the valuation, because normally companies need to have like revaluations depending on how big the company is, but like every quarter, for example, if it's listed on the stock exchange, or it can be every 1 or 2 years if it is private companies. Okay. So these are the main, so property really goes into the balance sheet. And in the balance sheet, if you look at the balance sheet, let me just see if I have the balance sheet here of company. The balance sheet tends to be on the, so if you get here, a balance sheet, you don't have this one here, but normally what it is that it is in the, I have here, I think the balance sheet. The balance sheet here tends to be, you have like, for example, this is a balance sheet of a company in Landsec. Then you have like investment properties, intangible assets, and net investment. So these are the non-current. So the biggest part here, if it is a property company, it will be investment properties. Okay, so that's the main thing that we need, that normally we work on. Okay. Right. What else do we need to know in terms of accounting? Uh, the profit and loss, EBITDA is also a term that we use. In accounting, people use a lot EBITDA, whereas when we are looking to, valuation, if you're a surveyor, we tend to talk about net operating income. Okay, so EBITDA stands for earnings before interest, tax, and depreciation and amortization. Okay, and then a very a kind of like similar name for it is the NOI. And then, as I mentioned, there is this idea of accrual accounting. And then this accrual accounting is really what gets to me, because as a property person, I normally look from a cash perspective. Like if you're going to receive the rent, is when you're going to receive rent. Like if you have, for example, in our case, one thing that we may be doing, I don't know if there are many valuers there, but we tend to do is like a vacancy period, or mainly like the rent-free period. For example, the rent-free period is an interesting one, because with the rent-free period, what happens is that you're gonna say, okay, I'm going to receive a rent of 100 for but I don't have I'm not going to receive the first year rent, right? So what the accountants would do is that it will still recognize the rent being received, even though you haven't received it, because it is a kind of accruing the rent, but you're not really receiving. So it will apportion your rent, even though there is no cash there. Okay, so that's a thing. So that's when the profit and loss account and the cash flow, they don't match, is because of this so-called accruals. If you have any questions, please do pop them on in the chat there. I'm happy to answer any questions. And then another thing that we need to know as a property person is the dividends, because with how the legislation goes in real estate, because if you have, for example, REIT status, which means that you are a real estate investment trust, as I mentioned, you don't pay corporation tax, so you'll be saving in fact, 25% these days of your income because you don't need to pay the taxes. The idea is that this REITs then is the income is distributed, so it's a tax efficient or tax transparent way to deal with the taxation, in that the shareholder will have to pay the taxes at their own income level. So if they're high earner, that they will pay a higher rate. If they're low earner, and then if it is, for example, pension funds or sovereign wealth funds that don't pay corporation tax, then it means that they don't have this tax leakage that we call. Okay, so these are things that we need to know. So the property income distribution, and it means that you need to recognize what is the distributable income, what is the this property, this PIDs that we call, in terms of what needs to be distributed, what will account as a PID that needs to be distributed at a rate. I think now is around 95%. So it's, if you're a REIT company, it is very hard for you. Well, it is normally you can't retain that much profit for reinvestment in the company. So everything that you receive, for example, rents, 95% needs to be distributed, or not only rents, but like the net rent, for example, after you paid your operating expenses, needs to be distributed. Otherwise, you may lose this REIT status, and you might start incurring taxation. Okay. Again, the types of accounts that we need to look at is the balance sheet. The balance sheet is the financial position at a particular point in time. And it's an interesting thing about the balance sheet, because when we're doing valuation of companies, of REITs, for example, what happens is that we look at the NAV, the net asset value. So what is the net asset value? Let me just see here if you have the NAV. So the net asset value is the one that you're going to have all your assets, so everything that you own. So for example, you might be your property, or it is your investments and so on, or it can be like a cash and cash equivalents and so on and so forth. And then you're going to have your liabilities, and then your liabilities here are your mortgage, for example, everything that you owe. So that's your liability. And then at the end, you're going to have your equity here. So the equity is the equity here. So then it's like the difference between what you owe, what you own, what you owe, and then the equity. So that's the net asset value. So in theory, the share value of this company should be this equity here, right, divided by the number of shares that there are. So in this case, there are 80 million here, ordinary shares, and then the total equity is 12 million, I think, the total equity of this company. And then they have, well, the ordinary shares, capital, own shares, and so on. These are not the numbers, these are values here. So if they have, for example, 12 million in this case, shares, then you should be trading at this £1 per share, right? So that's more or less what we're saying. But because we have the valuations in our industry, that is investment properties here, the 12 million, sometimes, so that's the 12 billion here. So the 12 billion here, it may not be 12 billion if you were to sell at everything. So that's the thing. Like if you were to look at the valuation of the shares and then compare with what we call the book value, right? The main difference is this revaluation of your investment property. So that's mainly what when we see like a discount to NAV or a premium to NAV. So normally it's people challenging here, what the values are. Let me just see, I have a Q&A here. So here there's a question here, why REITs often trade at a discount to NAV? So that's a great question. It's because of how valuations work, because what they say is that there is a lag in this valuation here. The UK is actually quite much better to look at this the investment, the valuations here. It kind of is more volatile than jurisdictions like I would say Germany that don't have that much valuation, or even the US that don't revalue their assets on the balance sheet. But the main idea of the discount to NAV is my take, for example, is because the properties here, investors think that they are overvalued. Okay, so if you think that the properties are overvalued because the equities market is what we call like the forward looking, then they say, okay, here your book value is 12 billion, but we believe that putting this in a perspective of a discounted cash flow, we don't think that this is 12 billion. We think it is 10 billion. So the 10 billion will have an effect on your equity, because instead of having assets of 12 billion, you're going to have assets of 10 billion, right? And this is one thing that if you're an investor in REITs, you need to take a view of what is actually this numbers telling you. And even like the borrowings, for example, because what it's not this is just showing what you have there in terms of your, what you owe now. But if, for example, is a company that has a floating rate. So for example, if instead of being a fixed rate, it's a floating rate, and then you think that interest rates will go up, then what they do here on the borrowing side is that they do what we call the market to market, saying that you will actually have to your borrowing is actually more because interest rates, you have to pay more interest rates, for example. Is that a good, yeah. So it might be those kind of like, though interest rates going up might be that, well, if it's fixed liability or not, but that's the main point of a discount to NAV is when investors think that the properties here are overvalued. Okay. There's also this other theory like that, like if you are of trading at a discount to NAV, is that there is a natural discount to NAV, because if you're going to, for example, buy all the shares and then sell all the properties and receive the equity, there is this problem of you. So you have to take into consideration that if this is your analysis, that you're going to take this company private, for example, there will naturally be a discount to NAV, because it will cost you to sell all the properties, to pay back all your loan, and then obtain the equity. So all things equal, even if they believe in the investment property being at the right value, there might be a slight discount to NAV when things are when they need to, for example, take the company private, for example, if they want to buy all the properties, sell all the properties, and so on. I hope it makes sense. What else is there on the balance sheet? So I think that's mainly the idea of the balance sheet, this idea of, so when things are going out well for property, there's a lot more premium to NAVs, because the premium means that they think that the values will go up, and then the 12 billion here might actually be 15 billion. But then also because you have the gearing side, right? So that's the NAV tends to be a lot more volatile in REITs than it tends to be in the property, like in the valuation world, that we don't take into account the liabilities. So that's also one thing to be aware of. Just another Q&A. Okay, so what else do we have here? Profit and loss. Profit and loss is mainly to look at the performance of a business for a specific period of time. So this is pretty much like where, like if the company is, for example, profitable. So in this case here, this is a little bit outdated, but it's just to give an example here, is the income of the property, and it tends to be the rent, okay? And then sometimes they put here this revaluation of the property here hitting your profit and loss, right? Because if you're not a property company, if you're just doing the revaluation of your building, for example, if you are, for example, like Microsoft, and then you're doing the revaluation because the building is not what you do for a living as a Microsoft. You do a software for a main business. The property is just your headquarters. Then you won't necessarily hit your profit and loss. So also, this is one thing to be aware of in the income statement that is different from the cash flow perspective, is that these revaluations will have an effect on the profitability of a company. So if the company is they have like the values of the property go up, and then they put this in your income statement, it means that you're going to be very profitable, but it doesn't mean that you have cash, it's because the revaluation of properties is not a cash is not a cash item, so to say. Your property going from 100 to 120 doesn't mean that you have 20 cash in your bank account. However, it does go through your income statement if you are a property company like Derwent is. Okay. Another thing about the cash about another type of account. So mentioning that we have the balance sheet. So the balance sheet is to give you an idea of what are assets, what are liabilities, and what is your equity. So it's mainly to say, okay, if you were to go bankrupt, for example, today, like what is that is left on the company, right? So of course, if you're going to go bankrupt, there is nothing left because you're going to have negative negative equity, negative NAV anyways. But is this idea that if for example, is a company that is trading on the stock exchange, if you were to take this company private, how much you would pay for it? Or if you are an investor, a retail investor, and then you want to buy shares in this company, how much more or less you would be paying? And then that's why we have the question of premium to NAV or discount to NAV, and that normally in our industry we tend to be more on the, especially now with the sell-off. There is a massive trend now for being negative NAV, but just because people expect the rents to go down, people still expecting, even though people are expecting interest rates to go down, they're not expecting that the values of properties are going to increase that much, because again, like in the stock exchange, they tend to be forward looking. No, they're not like backward looking as we are like in the valuation world. We need the comparables. Comparables are historic and so on. We need to be forward looking. So we need to be aware of that as well. And then what else do we need to know? So the cash flow statement, is an interesting one, because cash flow statement, I think I'm gonna look, I think my spreadsheet might be better here for the cash flow statement, because normally with the cash flow statements, we need to look at three things, and I quite like it because we look at the CFO, the CFI, and the CFF, i.e., we need to look at the cash flow from operations, cash flow from investing, as I mentioned in the beginning, and the cash flow from finance. So how much money you're making from your operations, how much you are investing, and how you are financing it. And these cash flows here are pretty good as a way for attribution, for example. What do I mean by attribution? Because there are a lot of people, a lot of investment managers, they'll say, oh, I just invest in core buildings, for example. So what do you expect if you are a core investor? If you're a core investor, it probably means that you're going to receive a lot of rent. So your CFO should be positive, right? Your CFI, if you have already invested, if you're, like if you are already in a mature business, your your cash flow from investment will not be that will not be very large in relation to your CFO here. Like like you're not gonna be that much, okay? And then your CFF, it might be that the only thing that is doing, like if you're a core investor, it might be that you're gonna have like a dividend distribution. So you're gonna be like a little bit negative, right? So that's if you are a core investor. So you can kind of check with your cash flow statements if the investor that said, okay, I'm a core investor, if it really is. Whereas if you are a developer, for example, then what do you expect to see? That you're going to have negative CFO because you're not generating rents yet. You're going to have very negative CFI because you are spending a lot of money building it, buying, refurbishing, building, buying land, and so on. And then your CFF needs to be massively positive because you need to raise money because it's not coming from your operations, it's not coming from investment, you're not selling anything. So it means it needs that it needs to come from your equity or your debt side. Okay, so that's your CFF. So that's a developer. So if you look at this company here, they generate some income from operations. So it can be like a developer that is already in operation, but they have negative CFI, i.e., because they're doing a lot of capex in the property. So they're doing a lot of development as well, right? And then where is the money coming from? The money is coming from net movement in revolving bank loans. So they are borrowing, yeah, for this capex that they're doing, they're borrowing on revolving loans. So that must be very expensive for them, but it's because they might not be doing, it's just like capex on current properties is not like redevelopment and so on. So that's why they are using here the revolving bank loans, okay? And then they pay here a lot of dividends, but the reason I think they pay a lot of dividends is because they need to distribute 95% of the rents that they receive as dividends because of the REIT status. Okay, so this is a good way for you to check what the investment look like what the company looks like. Okay. And then here we can reconcile the cash. So this is the way to do like on the this is the direct that the direct cash flow. But also sometimes what happens is that we start the cash flow analysis from the net income, and then you're gonna add to what the accruals are. So accounts receivables, depreciations, amortizations, and so on. But this one is quite good to see like where the money is coming from, or how it's being used, and how they are, financing the whole thing. Okay, so this is the accounting. This is the cash flow, and then what else do we have here? So the cash flow from accounting, the management accounts, actually, these are the main statements that we need to think about. Management account and company accounts, again, because one account might be used for for managerial purposes, so you can see what's going on in your company at a particular point in time, and then you might have like another set for company accounts. It doesn't mean, because sometimes people think that it's because you want to trick the tax. It's not about it, right? It's about what you need to report, because if you have, for example, HMRC, that like they have specific rules for what can and cannot be taken into account. Whereas if you are, for example, in your if you're looking as a manager, as a CFO, there are other questions that you need to raise, right? So this is also another thing why there might be two sets of separate accounts. Right. So from the cash flow perspective, this is pretty much what you need to know. And then when we're doing this kind of analysis from from an accounting perspective, and on the companies from a company lens rather than the property lens, one thing that is interesting is that we have a lot of reporting from the company. So we have like historic information, and then also in the forecast we have 2-year forecast normally. So they're gonna say, okay, what is the forecast for the next 2 years, and then these are figures that you can believe or not what the managers are saying in those companies, but we tend to go with what they say, and then from there on the forecast, then it is it tends to be a little bit easier, especially like if you're looking at REITs on the public market, like not private companies, but like if you look at Derwent, Land Securities, British Land, so on, because they tend to be more stabilized. So the figures shouldn't change that much from year to year. They tend to be generally more what we call stabilized operations. Even if it is, even when they are doing, for example, CapEx on properties, they tend to have an allocation, for example. Disposal of property. So that's one thing that it goes into your CFI and not your CFF. Okay. Income statement, it's a bit of what is the profitability. Again, when you talk about the profitability, it's the interesting thing for us is to look at the revaluation surplus here, because if you are in a market that the values will go up a lot, then it might be that the company seems very profitable, but it doesn't mean that there's a lot of cash going on there, right? It means that it might be cash if they can, for example, remortgage and refinance their loans, and then might become equity, but it might become cash, but it's not at the face value, that is not there. So that's the main difference between income statement and cash flow, is the accounts here that are not cash accounts, but they still increase profitability. And again, if you're doing, investment analysis, a company can be very profitable, but not liquid. And then liquidity is more important than profitability, because, some people say that you can remain profitable for a long time. Another way around. You can remain unprofitable for a long time, but you can't remain illiquid for a long time. Okay, so that's the main thing here, that if you are unprofitable, but there's a lot of people putting money in your company through equity or debt, then you can remain doing that. But sometimes you might be very profitable, but illiquid, because people think that you are not worthwhile being invested in. So these are the things about your income statement and your cash flow. And then you have here the balance sheet as well. And then again, the balance sheet for a property company is pretty much based on what is your investment property. So here in this company, Derwent investment property is what they do, right, for a living. They invest in properties, but they also have the PPE side, and the PPE probably is their headquarters. So what they the building from where they operate. Okay, so this is what, and then for us to do the valuation side is pretty much to look at what is going to be the forecasts, and then look at the upside and then downside and come up with a notion of what is the value of the property given the forecast. So that's why the NAVs might be trading as a discount, because the forecast here paints a not so good picture rather than what it is now being painted from the net asset value from the equity now. So this is the main idea of valuations, the share valuation, and how accounting is important here when we are looking not at the property level, but at a company level. Okay. So this is what I had for you today. If you are interested in knowing more, please do join us in our courses. Okay, so we have a new course now about equity valuations as well, and accounting for property and forecasting as well. If you're interested, please drop me a line. Okay, I'll be happy to see you. And in general, if you have any questions, please give us a shout. You know where to find me. And it was a pleasure to see you all. I didn't see you, but it was a pleasure to talk to you today. And please keep coming and tell your friends as well. And if you need anything, I hope I can help. Okay, so. Oh, I have another question here, anonymous attendee. When valuing property, which standard should rely on, IFRS fair value or RICS valuation? Will they often come to the similar conclusion? Even the RICS valuation needs to be because one thing is the standard. So the RICS standard needs to be in line with the FRS fair value, right? So I'm not sure what there is no such a thing as the RICS valuation as such. Like it is the standard, like we as a red book valuer that we call, right? We have our standard, and then this standard will give the what we call the FRS fair value, right? So we need to know like how our procedure should match what the FRS is saying. You can't just I think they should be they should be in line. I hope I answered your question. The nosh here is the I don't know what is like the nosh is the number of shares. Nosh, number of shares. So is the number that you're going to divide your equity by in order to get the value of your shares. Does it make sense? Freddie. So maybe you create, Freddie, another table with the nosh. No, we don't need to. It's just like the share value. You divide by the nosh. Okay. Any other questions? No? If no further questions, I hope I see you again soon. Okay. And thank you so much for attending. Adios.